Hello and welcome back to the channel. Today we're talking about credit score and why it doesn't matter. I know there's a ton of videos out there and articles talking about why you should get your credit score up, going over the benefits of having higher credit, working on building your credit to be able to get things such as better interest rates on loans, open up credit cards, amongst other things. But I think this is a really good learning opportunity to get a better understanding of what credit score is and isn't, and some of the things that you need to consider beyond just the credit score when you need to go make a big purchase or get a loan. All right, to start off, let's get into this by talking about what a credit score is exactly and how it's calculated. So a pretty simple definition is a credit score is a number ranging from 300 to 850 that depicts a consumer's creditworthiness. Generally, the higher the credit score, the more attractive the borrower. So you'll see here with mortgages, loans, auto loans, generally with a higher credit score, you'll have access to better financing options. So lower rates, lower interest, things like that. Also, for some of the higher tier credit cards that offer you better rewards and benefits, you generally need a higher credit score to be approved for that. So now we know what a credit score is, but how is it calculated? So there are a couple different credit agencies, but generally credit score is made up of a couple things. So lenders have access to all this data, and credit bureaus compile all this data and spit out a score for you. You've probably heard of a popular score, FICO. That's one of the agencies that comes up with these scores for consumers. So on this scale, generally speaking, 700 or above is a good to excellent range. They're broken down into a couple buckets, but most people are either good, very good, or excellent, with good having a threshold of 670 and excellent ranging from 800 to 850. So now that we have a very basic idea and understanding of what a credit score is and what it's made up of, we can talk a little bit about things that it has an impact on and things that it doesn't. So generally, when people tell you ways you can raise your credit score, these involve things such as lowering your utilization ratio. So if you have a credit limit of $1,000, you want to keep that under a certain percentage. You're not maxing out your credit cards. Other things, paying off your statements in full every month, not having any late payments, looking at keeping lines of credit open for longer, so having a longer history of credit and opening up more accounts and more files responsibly to show that you're able to responsibly manage the credit that's given to you. But if we look at these criteria and the suggestions, we see that credit score uses data from your past to try to determine your creditworthiness. So for example, if someone has $1,000 credit limit, they're using up that $1,000 every single month and they're not able to pay that off, then their history probably doesn't look as good. But one important thing when we think about your credit score and your personal finance is your income and your savings. Nothing on your credit score or your credit report talks about how much money you make every year. Your income doesn't take into account your income or your savings and assets, which are obviously very important for a bank or a lender to look at when they're deciding whether or not to loan you money. So for example, someone making $10,000 a year could have a credit score of 800 if they have a lot of credit cards opened up, or maybe they have a small loan that they're able to pay off every month. They're never late on any payments. They have their utilization down. They have a long credit history. They can very well have an 800 credit score. But what we're going to talk about later on in this video is if we don't take into consideration your income and your savings, you might not be able to have access to a lot of things that a higher credit score is typically tied to without the income and savings. On the other hand, you could be making $1 million a year, but if you're maxing out your credit cards, you're not paying your loans down on time, you could very well have a terrible credit score. So your income or savings doesn't necessarily dictate your credit score. Right? So in addition to articles and guides talking about the importance of credit score and raising your credit score, there's also a lot of literature out there talking about how you don't necessarily need to chase after that 850 or that 800 club, although it's great to have a very high credit score. some people think that it doesn't actually do a whole lot for you. Just having a good to great credit score should be enough for most people to get by, to get the best rates or close to that for loans or mortgages, and to have access to most credit cards out there. Right? So as long as your credit score is not completely terrible and you're able to pay off your debt on time, you should be in a relatively good place. So this is why personal finance as a general concept and a general idea is important. It looks at more than just a number, your credit score, your credit cards, your credit history. It's really focused on building up your wealth, learning how to save money, how to invest money, and how to manage your money and personal finances. I think it's important to know that credit score is just one piece of it. Once again, it's not going to determine everything. For example, I gave that income example earlier, but let's say you're 20 years old, you have an 800 credit score, which is awesome. You're not going to be able to go out there and get a loan or buy a house if you don't have any income or savings, right? Lenders are still going to look at how much money you can put down on a down payment. They're still going to look at your income, your savings account, if you're able to make those monthly payments. And having that credit score, having that high number is not going to be enough just to get you that. Or if you don't have any income, any savings, you might not even get an auto loan just with that high credit score, that high number. But what is important is to start building it up early on, thinking about these concepts consistently and often, and evaluating where you are at in regards to personal finance. So although a 20-year-old with an 800 credit score is not going to be able to go out there and get a loan for a mortgage, what they will be able to do is live by those principles, keep that utilization rate low, pay those bills on time, develop good habits so that when they are older, 30s, 40s, and it comes time to buy a home, their credit history is solid. It's perfectly clean, no dents. They haven't had to climb out of any holes, climb out of bankruptcies to try to fight back and get access to good interest rates, good financing offers. They're all set. There's nothing extra that they have to do. And same with people who didn't really focus on credit or haven't opened up a credit card in their mid-20s or even late 20s. If you need to buy a car or a house tomorrow and you have no credit history, it's going to be very hard to try to get a loan once again. So I think at the end of the day, the lesson here is that credit score is not the end-all be-all. It's a metric that's used by lenders and credit companies, but they're always looking to come up with new ways to try to predict your ability as a consumer to pay back loans and your creditworthiness. We see now with the global pandemic and the economic uncertainties, lenders and banks are kind of walking in blind to a lot of their consumers due to payment delays, payment reliefs, mortgage forbearances. Companies now aren't necessarily allowed to report late payments or have to grant extensions. So we're kind of in a time where things are a little bit uncertain as to the exact creditworthiness of a lot of consumers. And we know rising consumer debt and student loan debt has been an issue for decades now. So now we see banks are trying to fight that and combat that to avoid mass delinquencies and mass bankruptcies by consumers by really tightening their standards and not approving new lines of credit as easily as they might have before. We've seen FICO try to introduce a new metric to measure the resiliency of consumers during recessions to try to have a better chance to forecast how you as a consumer will be able to react to economic slowdown or economic hardships. So the industry is always trying to get a better grasp at the consumers, but us as consumers can also put ourselves in a position to succeed by having everything locked down, having that good credit score, good payment history, good savings for the future, so that when lenders and banks are tightening their standards, we're still able to have access to the credit that we need, whether we need to get a house, a new car, or other loans to start up small businesses, we're able to do that. So that was a quick rundown of credit scores and some things that are going on now during the economic slowdown. If you have any questions, feel free to leave them down in the comment section below. If you like the video, hit the like button. Really would appreciate the support. And if you're not subscribed to the channel, hit that subscribe button. It'll only take you a second, I promise. But thanks for watching. Peace.